Welcome to this ValueBridge.net case study. This time we'll look at a cross-border value bridge and the kinds of data that you need to measure it. Let's say that the limited partner is a public pension in the US. They invest in a fund manager who is based in Europe, and the GP acquires a company that operates in Spain. So capital first goes from USD to Euro and then into the company, and when the business is sold, the capital makes the return trip. We want to measure how much value creation comes from things that the manager can control versus broader market forces like market multiples, addressable market changes, and foreign exchange rates. We start with a set of portfolio company metrics that are in the fund's native currency, Euro. Investments include the initial platform and an add-on acquisition. And realizations include an equity distribution and the proceeds received at exit. Value creation is driven by how these numbers change over the holding period, specifically absolute changes, holding period averages, and equity return multipliers. The fund's total return in Euro is on this line. The GP realizes 136 million on an investment of 48 million. This provides equity value creation of 88 million and a gross multiple of invested capital of 2.833. Given these metrics, we can calculate 6 value drivers, including revenue growth, EBITDA margin expansion, EBITDA multiple expansion, gearing, cash flow generation, and fund ownership impact. We will not dwell on the math in this video because we cover it elsewhere, but it's all laid out on the case study page, which also includes a downloadable Microsoft Excel template. They give us the following value bridge in Euro, where the difference between the 48 invested and 136 realized includes 46 of cash flow generation, 20 multiple expansion, 12 from debt amplifying equity gains, 10 from improving the company's EBITDA margins, and relatively minor revenue growth and equity dilution. Going back to the table shows that the 20 million of multiple expansion comes from increasing the blended valuation multiple from 4.77 to 6.0. To measure the market versus the manager impact, we need a good proxy for broader market valuations. PitchBook could be a good source for these numbers, but I like investment banker reports like this one from R.W. Baird. You can get access by signing up for it on their website. The M&A Outlook includes handy tables like this one, which says European middle market M&A multiples were about 8.4 at entry and 8.0 at exit. This suggests a contraction in market valuations over the holding period. Plugging the numbers into the table shows that at entry, the company is worth only 56.8% of the market valuation, but by exit, it's worth 75% of the market valuation. The changes in market multiples and discounts suggest that multiple expansion is comprised of a 4 million euro loss driven by broader market forces, and a 24 million euro gain that we call intrinsic multiple expansion. This is something for which we usually give credit to the GP. It can come from buying a company at a below market valuation, selling at a premium to a strategic, or materially improving the quality of a company's revenue and earnings. Next, let's look at the company's top line. It only went up by 2 million euro, or about 2%. Is that good, or is it bad? That depends on what's used as a proxy for the company's addressable market. Industry research reports often provide this data, but you can also use economic data, which is widely available and typically free. For illustrative purposes, let's use the GDP of Spain since the company operates in Spain. When we do this, we're basically saying let's make sure that any company that we invest in is performing at least as well as the country as a whole. According to the St. Louis Fed's website, Spain's GDP went from 306 in 2018 to 350 in 2022, which is an increase of 14.48%. This significantly outpaces the company's revenue growth of 2%, so the company loses market share, which this formula measures as a relative decrease of minus 10.87%. Plugging alpha and beta into the table says that the total revenue growth of 1.7 million comes from a positive market-driven gain of 11.7 million, but most of it's wiped out by a loss of market share, a manager-driven return of minus 10 million that's attributed to the company underperforming broader market conditions. Alright, so far all the value drivers have been measured in Euro, but they can be converted to the limited partner's native currency of USD using foreign exchange rates. For this, you want to use the exchange rate where the fund's currency is the base currency. So in this case, it'll be quoted as EUR/USD. This tells us how much USD we get or need for each euro, and again, this data is both widely available and free. Given the exchange rates, the fund's initial investment of 40 euro corresponds to a draw of 46.5 USD, and the add-on investment of 8 euro corresponds to a draw of 8.8 USD. They add up to 53.3 USD, which provides the blended entry exchange rate of 1.1524. Next, the fund's equity distribution of 16 euro provides 17.9 USD to the LP, and the exit proceeds of 120 euro provide 118 USD to the LP. They add up to 135.8 USD, which provides a blended exit exchange rate of 0.9986. These values provide the following differences, averages, and multipliers, and here the strengthening of the US dollar has a material impact on the LP's return. In the fund's currency, euro, the investment returns 136 on 48, or 2.833 times invested capital. However, in the LP's currency, USD, the investment only returns 135.8 on 55.3, or 2.455 times invested capital. Converting all the value drivers from euro to USD will quantify this, and the key is this average holding period foreign exchange rate of 1.0755 USD per euro, which we get from these two numbers on the left. To convert all the value drivers in this case study to USD, we can simply multiply them by 1.0755 as follows. I will just briefly display these equations here on the screen. If you want a closer look at the math, make sure to check out the case study page. Now, we are almost done, but these value drivers don't quite bridge the gap between the invested capital of 55.3 USD and the realized capital of 135.8 USD. For that, we need the change in the foreign exchange rate, which comes from these two numbers, and the average holding period fund equity value, which comes from these two numbers. The amount of equity value creation from foreign exchange impact is equal to their product. In this case, that is a loss. Minus 0.1538 USD per euro times 92 euro provides a foreign exchange loss of minus 14.15 million USD. When you plug these numbers into a chart, you get a value bridge that starts at 55.3 USD and ends at 135.8 USD, and the changes are fully explained by the value drivers calculated above. Now, when we get to this point, we can rearrange and combine these value drivers in any way that we see fit. For example, let's move all the market value drivers to the left and the manager value drivers to the right. We can then aggregate them into a market-driven return of 6.1 million, a manager-driven return of 86.6 million, and these combine to provide the correct total USD return of 80.5 million. And then once we get here, we can use the math on the site to convert these numbers to any of the other 4 units of equity value creation. For example, times money value creation, relative value creation, equity return multipliers, and value creation IRRs. This last measurement works a lot like public market equivalence or PME, but it is superior in many ways. First, it's not affected by the portfolio company having different leverage levels than those in the index, and as you saw, you have complete control over the market valuation and growth metrics, so you can fine-tune them for whatever is most appropriate for your private equity deal. Thank you for watching. I hope that you found this helpful. Make sure to check out the case study page at valuebridge.net for a downloadable Microsoft Excel template and a complete demonstration of all the mathematics in this video.